All right, we're live. How many people are here? We'll just give some time for more people to join in. Okay, I do see quite some people joining in now.
Umar should have worn my Web3 CFO Club sweatshirt that I got at December. I totally forgot.
Yeah, I won't mind.
Oh, that's awesome. I was like, well, I went for my HashBasis shirt, of course, but yeah, that's like my favorite sweatshirt. I wear a lot at home.
Good to know.
I'm
Yeah,
still waiting for
great
mine
to
in the
meet.
post, Umar.
Tell me again.
I
You're
said I'm
still
still
waiting
waiting
for
for mine in the
yours.
post.
Yeah, hopefully I can give it to you in person next time we meet up.
Yeah. Yeah.
We want to do that actually probably in May, organize like an in-person event and just for everyone, all the members of the Web3 CFO Club.
Yeah, that'd be awesome.
All right, so I think we can start. How many people are here? Okay, I'll just start with the intro. All right, so welcome everyone to a new webinar on the Web3 CFO Club, which today is on choosing a crypto accounting solution. I was speaking to Tal, the CEO of Trust Finance, and Jay, the CEO of CryptoWorth, two crypto accounting solutions, and they both said that it all boils down to completeness and accuracy of data. Related to fetching the on-chain transactions, processing and categorizing them into your subledger before then being exported to your main accounting ERP, the main ledger, which is being used for your financial statements. So to discuss how to choose a crypto accounting solution, we've got three crypto accounting experts for you today. We have Mackenzie Patel, the founder and CEO of HashBasis, a crypto accounting firm in the US, and Mackenzie was also previously the revenue accountant at Figment, a validator on over 50 proof-of-stake networks, probably more at this point. We also have Joe David, the founder and CEO of Myna Accountants, also a crypto accounting firm, but in the UK. And finally, we have Greg Mocnik, the CFO at dYdX Foundation, whose mission is to empower traders to use open crypto financial products. So Joe and Mackenzie have both worked with many of the crypto accounting solutions out there. And I think Greg's insight will be quite unique as dYdX Foundation is not using a crypto accounting solution, but instead Greg shared that he developed his own model that is being used as a subledger for the crypto transactions. So with that being said, maybe I can share a little bit more about what is the agenda, and I'll just share a little bit more about the Web3 CFO Club, which at this point, I'm sure many of you are familiar, but for new people joining. So the two goals I would have, I would say with the Web3 CFO Club today is to just share best practices for Web3 financial operations and just to allow yourself to network with your peers in Web3. Today we have 350 members. It's actually growing quite fast. And also the reason behind it is we felt there's a lot of communities for devs in Web3, but the missing community is for finance and operation leaders like yourself. For example, in the past days on Slack, there's been a lot of discussions around which banks to use, alternative banks to use in the US and in Europe. So this has been very helpful for members to chime in and share their experience. That being said, Yeah, so next, why don't we have, I gave a brief intro of the speakers in the beginning, but I'll let the speakers themselves tell us a little bit more about what they're doing around crypto accounting. So Mackenzie, would you like to go first?
Sure. Hi, everyone. I'm Mackenzie. I'm super excited to be here today. As Umar mentioned, I'm the founder and CEO of HashBasis, a crypto native accounting firm. And so we help businesses and individuals get their crypto books in order. And part of that is implementing subledgers for them and doing the monthly crypto accounting on top of that. And so also before that, I was leading up crypto and revenue accounting at Figment, a validator. And before that, I was doing revenue accounting at Honeywell. So really excited to be here today. And this is probably one of my favorite topics that I'm already thinking about all the time. So excited to share what I've learned with all of you.
Thanks, Mackenzie. And Joe?
Yeah, hi guys. Similar to Mackenzie, we're an accounting firm focused on crypto accounting for businesses and individuals. Probably the big difference is jurisdiction. We're in the UK, so we pretty much look after anyone that isn't in the US. And we'll leave the US to Mackenzie and her team. So yeah, we work with projects across the globe, like I say, with some some large big names and some also some small kind of institutional traders, etc., etc. Yeah, our focus has always been, as a business, always been kind of tech founder startup focus and support clients in that way, and crypto naturally fell quite nicely into that. Also, myself being a bit of a degen allows me to kind of learn the mistakes the hard way, and then yeah, kind of show the clients how to do it properly. So yeah, really good to be here. I'm really excited for this conversation today.
Thanks, Joe. And lastly, Greg.
Yeah, hey guys, thanks for having me. Yeah, I joined dYdX Foundation about a year ago, almost now. At Foundation, I'm responsible for a lot of the different things. One of them, obviously, touching this webinar is accounting. So I do take care of or coordinate a lot of the accounting efforts across all of our entities. I'm also on the payment side, so executing payments and everything around finance, budgeting, and forecasting. Also looking, or will be looking more so in the near future into treasury products. Also very involved on the payroll side, the T&E, and basically everything on the back-end operations of finance and accounting. But yeah, my background is more of also in the finance and accounting space. I'm a CFA and ACCA charter holder. Came from Facebook. Before that, spent 5 years in IB. So I'm very excited about crypto space and this topic. So looking forward to this webinar and discussing Web3 solutions for the accounting aspect.
Thank you, Greg. And lastly, a little bit about myself. So I'm responsible here to grow the community and organize different initiatives like the webinar we're having today. I also run a podcast on crypto accounting called On the Accounting Quits. I've previously had Joe David and Mackenzie Patel, actually. And so during this year with the Web3 CFO Club, we want to have more initiatives, also to meet in person, create more resources like we did with the Web3 CFO guide. So if anyone is interested to be a contributor in the second version of the guide we'll have later this year, just reach out to me on Slack and just let me know. So with that out of the way, so the agenda for today. So this is the agenda we'll have today, and we'll keep a Q&A, 10 minutes Q&A at the end. You can post your questions in the chat, but I think it's better if we take all the questions at the end. And lastly, a disclaimer that this webinar's content is for general information purposes only and is not a substitute for consultation with professional accounting, tax, or legal advisors. So the first topic that we'll discuss today is on the need for a subledger for crypto accounting. So I want to ask the speakers today, what were the challenges you encountered when you first started accounting for crypto transactions from all these different data sources that I've listed: block explorers, exchanges, wallets, DeFi protocols? And could you go a bit through the complexities of having to import these transactions on-chain for bookkeeping?
Yeah, sure. I could take this one first, just because I definitely have encountered a lot of challenges with regards to this. All fun stuff though. And so I definitely think that completeness and accuracy, as you mentioned earlier, is really the most important thing. And so the first thing for me is making sure that we have a complete set of wallets. And so in crypto, it's super easy to just spin up a wallet in a few seconds, but at least on the accounting side, you really need to have a complete set, because that's the data that you then are going to import into your subledger. And so if you don't have a complete set of wallets, then your data is not going to be correct. Your entries are not going to be correct. And so that tends to be very challenging, especially if you've been in a crypto company that's been around for a while and maybe they don't have like a set of all their wallets all the time. Definitely need to have that, because it just makes the accounting so much easier. And then kind of on the flip side of that, you need to have a complete list of wallets, but you also need to have complete data set for all of your activity. And so it's a little bit tricky, because I feel like getting data is definitely the hardest part of my role of doing crypto accounting, because there are a lot of obscure chains out there. So let's say you're on a subledger and they support Ethereum and Polygon. That's typically fine. Like usually those chains are syncing in and all the data is going to be pulled in. But the real challenge for me became like when I was looking for chains that were more obscure or not supported by these. And so in that case, it's a lot of manually gathering data, reconciling it, uploading it, and there's a lot of points of error that can be introduced there. And so I have this example that I always like to point out. So when I was previously at another company, they were validating on Kava. And so Kava has upgraded like 7 times or something ridiculous like that. And so there was a new Genesis JSON file for each of those 7 upgrades. And so I really had to go to each one of those JSON files, make sure the beginning balances were correct, reconcile, and then upload. And so that's just one example. Like the chain can upgrade multiple times, which definitely affects your data collection process and just makes it a little bit more difficult. And so I think just a general rule of thumb is that the more data you're trying to manually import, like if it crosses multiple years, it's just going to be more challenging, because a lot of these historical transactions, you might not know what they actually relate to. So if there's a random transaction from 2019, maybe the person that executed it isn't even there at the company anymore. Maybe they don't remember. And so it's really on the accountant to figure out what is this, but sometimes it's not that simple. And then one other thing that I wanted to mention here is that something that I really struggled with a lot is that a blockchain is cash basis, right? It just sends and receives, and it's all cash basis in my mind. And so a lot of what I think about is how do I reconcile the cash basis nature of a blockchain to the accrual based nature of, let's say, US GAAP financial statements. And so another example I like to use is any of the Cosmos network. So rewards are continuously accruing. Let's say for staking, they're accruing, you're earning them, they are revenue, but you don't actually see the transaction until you claim the rewards. And so there's just like a fundamental like gap there between, the US GAAP accrual version and then what's happening actually on chain. And so you have to be able to reconcile that. So yeah, I could probably go on. There's a lot more challenges that I encountered, but those are the main ones.
Yeah, I think I jump in. Sorry, Greg, do you want to go?
Sure, go after it.
No worries. So I think like kind of following on from what Mackenzie just said, I think one of the biggest problems or one of the biggest issues that this has been in the past has been handling the DeFi side of things, handling a fairly kind of simple front end, wallet to wallet transactional basis, through, an EVM chain or Bitcoin or anything like that. It's fairly straightforward, but now it hasn't been, but now given the tools that we've got and we're able to extract a lot of the data, the biggest problem that we've had is we do a lot of work for a lot of DeFi protocols, and it's understanding a lot of the transactions that happen behind the scenes as well, or kind of off wallet, as you would call it. So kind of following on, Mackenzie, from what you were talking about with the Cosmos side of things and the rewards kind of accruing in the background, that sort of process with some DeFi protocols, we've had some issues getting the data from the protocol itself in order to then be able to put that into the accounting records, and you'll see these big gaps that you just kind of you don't necessarily know what they're for, and as you said, Mackenzie, the client quite often, depending on how far back that was, may also not know exactly what big black hole that bit of money went into. So yeah, it's I think that's the key for me is as we grow as an industry is making sure that the systems and kind of things that we've got around us, and there are some great ones, as you've already said, Umar, that some of them that are on this call today are able to kind of keep up with the technology and able to come up with innovative ways to track some of this data that may not be quite as simple as a front end solution. So yeah, I think that's been the biggest challenge we've had.
Yeah, just adding to what Mackenzie and Joe have already said, I think one of the challenges at the beginning that we had was finding a solution that's automated, scalable way to, track all of the on-chain activity that you have across different connections, like you have here in data sources, right? You may be connected or have cold vaults on exchanges, and you have a bunch of different multi-sigs and hot wallets, that you're self-custodying. So I think that's been one, and then just like figuring the structure of how do you monitor those. Is it, I think one of the questions that you're asking the following is like, are you tracking per asset, per wallet, per blockchain? I think as the Web3 space develops and people choose to be paid in USDC on Ethereum mainnet or on BSC, and when the market picks up again, those gas costs become a little bit more of a question again. I think the complexity will increase even more. So having a solution for that, I think, will be crucial. I think each of us have probably fought that problem a little bit differently. I think for us, we're just very simple in terms of how we do payments today and the number of payments that we do. So I can talk about a little bit of later on how our subledger looks like today. But I think the one challenging aspect that I was facing at the beginning when I started was, how do you basically document the transaction entirely, right? I think it's fairly easy to extract data from Etherscan. It's another thing when the accounting looks at it and they need to be able to understand the nature of that transaction, have an invoice, like Joe said, or Mackenzie, this is cash flow accounting, right? But when accountant looks at it, we're all thinking about debits and credits and accruals, right? So I think that's where like a little bit of disconnect is with and complexity comes in. So I think when the subledger that looks like today for us always also includes a GL account. There's some sort of like manual description and then supporting documentation that gives basically all the information the accountant needs to be able to understand the transaction and book it appropriately, but also for us to have basically a full audit trail of every single on-chain transaction activity that occurs on-chain across all of our wallets and assets, right? I think that's been like one of the challenges that I've been facing. But then I think also for a non-US based foundation and protocol, so all of the payments on chain today or that we make them in USDC, right? So there's like conversion that needs to happen into your, we're a Swiss based foundation. We do local reporting and under Swiss GAAP and CHF, right? So we need to be able to record transactions in CHF. So how do we make sure that, the USDC to CHF conversion takes into account the USDC to USD peg and then converts over, to CHF? What exchanges are we using? What happens with gas? I think there's a lot of like different interesting complexities that come out of that, I think the accountants just are not up, or not everybody is up to speed, at least, personally speaking with the accountants that we're working with locally. A lot of the times they're coming and seeking for your advice and, asking you to do, a lot of explanations and providing supporting documentation. So I think that's been a bigger factor for us, and maybe a reason why we've decided to at least, today be doing this internally through our internally developed model.
The next slide is on examining data sources, and I wrote down a few categories there. Maybe I missed out a few, but this is like a high level, some high level categories. So first I have that you have to understand the data source, then you have to extract it, like you guys have just spoken. Then you have to process and categorize the data before finally syncing into your main ERP accounting software. The question that I'm going to ask you is, what are some of the good practices for each of the above, for each of these categories? Maybe we can go through each one at a time. So firstly, when it comes to understanding the data, so someone has just started doing their crypto accounting. How should they approach it? What firstly, I wrote, so they have to identify all the different data sources they are pulling information from and have an understanding of the inflow and outflow of funds.
Yeah, I think there's.
Go on,
go ahead. Okay, just a few things on the understanding. So I think understanding is that like the token flows is super important. So even just diagramming, like what is actually happening when you do whatever activity. Like I always love referring to liquidity providing because there's so many different steps that have accounting implications. Right, you put the pair in, you get the LP token back, you stake the LP token, you're getting rewards, then you're like unwinding your position. So like for me, I just made like a diagram of what was actually happening and then identified all like the tax and accounting events that happened at each step in the flow. And so that really helps. I always say that accountants are kind of like researchers when they're doing crypto accounting because you can't just like understand US GAAP, you have to understand whatever guidance and then also like the underlying crypto activity. So yep, just doing research is the biggest tip I can provide.
Yeah, I think as well, like from my side, coming on from that, and it will kind of answer the top one, understand, and then the third one, process and categorize. The biggest thing fundamentally, I think, is breaking it down to a traditional business model and what exactly is the underlying business model that this business is interacting with. So, if it's an NFT project with a membership, kind of, system or whatever, then breaking that down to the traditional business model will help you to really understand exactly what sort of transaction flows you would expect, as well as what transaction flows you can see. So at that point, you might think, right, okay, well, in this business model, I would expect flow A and flow B. And if you can only see flow A, then there's an opportunity to say, well, what about this? How does this differ? And get an understanding from there. I think I also likened it earlier to a jigsaw puzzle, in that you can only do a jigsaw puzzle if you've got every single piece, but you don't always know if you've got every single piece until you build as much of the puzzle as you can, right? And this is the same here. You don't always know on day one, and I'm sure, Mackenzie, you have the same problem where you ask a client for all the wallets and they give you 8 out of 11, and then you do all the work on the 8, and then you realize that there's 3 missing, and you've got to go back and look and unwind. And so again, it's that it's that piece as well that's I think really important, is the getting that like understanding of the fundamental business model first. That should then help guide a bit of your thinking, and then using that to understand the flows, but also to then help you process and categorize the transactions. I think, if I'm honest, the extract piece, it to an extent is getting there now. We've got, as you already mentioned, Umar, some really good guys on the call, and the extract piece is really every day is getting better and better and better in terms of extracting that data from block explorers. The biggest problem I have with that is coverage. But again, I totally understand why products focus on an EVM chain, for example, rather than we have one the other day who's got 12,000 transactions on Internet Computer Protocol. We've not touched a client on Internet Computer Protocol before. So how do you handle that sort of thing? And you can't just expect a provider to be able to extract data from all these different bits and pieces. So yeah, I think that part is getting there and building up. But the first two are definitely much more around understanding the business model and trying to put that puzzle together.
Yeah, I mean, not much to add here on top of Mackenzie and Joe, but yeah, I think just like understanding the infrastructure that you're operating on, what type of payments are you making, and what token, what blockchain. I think that gives you a good foundation point to then know, where do I need to connect to? That Etherscan, is that another blockchain explorer? How does like, I think Mackenzie, you mentioned a little bit on Cosmos operates a little bit differently than Etherscan, and understanding the transaction costs and where those get deducted, like just simple things of like, I'm paying in USDC, but then the gas is denominated in ETH, so that gets deducted off my ETH wallet. So it's just basic things like this. I think that sets you up for success when you need to go into some of these more later stages of documenting, bookkeeping some of the transactions.
We spoke about understanding and extracting the data. When it comes to processing and categorizing the transactions, so I wrote a few different sections there. So the tax method, obviously, this will vary as per the jurisdiction you're in, maybe. And this is, if you're using a crypto accounting solution, you'll have to set this up in the beginning. It's a one-off setup, and so you don't have to change this every now and then. But when it comes to, for example, categorization, I want to ask you if you could maybe give us an example of an individual categorization or rules-based categorization that you guys make when you use a crypto accounting software. Do you have an example?
Yeah, I take the wallet structure into account. So if it's a wallet where multiple functions are happening within it, let's say it's used to pay contractors, but it's also used to receive income, also used to pay for gas fees. I find that to be a lot more difficult to apply a rule to, just because there's so many different things that are happening. And so for those types of wallets, I either tend just to categorize it sort of one-off, which can get very time consuming. But so, which is why I always recommend for clients that when they're setting up wallets, try to identify, like, have one wallet equal to one function. And so a good example, let's say you invoice a client and they only pay in tokens. I would recommend setting up a specific wallet for that client to pay to. And then so you know, like, that this client is paying to this wallet for whatever services that you're providing. And so in that case, that makes it super easy to run a rule on top of, and you can identify the exact GL account that you want to apply there. And so that's what I would recommend, but it's tough if you already have those wallets set up and there's lots of functions sort of happening within them. There's a lot of cleanup that sort of needs to happen after that. But if there's clean wallet structure, you can just apply the rules and it does make it a lot easier. But it really depends on how the client's been set up so far.
Yeah, we also have different mechanisms of how people want data presented. So, some people want data presented by token, so they want to see the balance sheet, per token, and they want to see the tokens that they're holding, and therefore the wallet they're on, to an extent, is irrelevant because it's more about the token they're holding. So they might have ETH across 5 wallets, but all it will show on the balance sheet is ETH. And other people want to see the wallets as a similar to how you would see a bank account, in a sense that you'd see X wallet with X balance, and again, you've got to have a mechanism to manage that as well. I think the key for me is again, coming back to this business model understanding perspective. If our business model is all around being a staking operator and receiving staking rewards, and we can typically see the staking rewards coming in from a particular wallet address, we can tag the wallet address as the staking reward kind of address, and tag the relevant transactions from there as staking rewards. And in the background, we're able to then categorize what that rule would mean. So that rule might credit revenue of some kind and debit a token or a wallet or what have you, balance sheet account, as an example. And you can build all of that into the background so that every time then you block select all of the transactions for that wallet for that category, you can then pretty much sync those very quickly. So again, coming back to the preparing at the start, really understanding the business model, understanding what they're doing, and setting these things up from day one is, for me, is the key to kind of smoothing that process as you go. So most of them these days are going to allow you to categorize and kind of bulk sync, but that's again, the efficiency is in that piece, really, I think.
Yeah, I think where the categorization and labeling, at least on transaction side, happens is for us is on a payment solution that we're using built on top of Gnosis Safe. So every time you're adding a contributor or a contractor that you're paying to, they get added a label, and whatever that may be, community management, marketing expense, whatever. I think that just basically we use that data to then input into a ledger. There's not automatic way to do this currently, at least for the new contributors. For the recurring payments, that is kind of like sort of automatic. But again, for our size and the number of transactions that we make, that's completely sufficient. Then in terms of just the wallet structure, we basically keep them. Every address can have, like, you can hold different assets and tokens in it, right? So you can have a USDC attached to the same wallet address. So we basically keep USDC, ETH, NFT, whatever tokens you may have tied to that single address, and separate kind of like worksheets, and then extract and connect to different endpoints to pull those transactions in. So that's kind of like how it works with us.
And Craig, can I ask you if you would have some examples of these automation practices, just to remove that manual work every month when it comes to closing your accounts every month?
Yeah, I think that, one thing that I think would help is, a lot of like Foundation is, and probably other protocols are using some sort of, I don't want to put names in there, and like payment Web3 payments providers, like, like you keep your address book. That's where you make your batch transaction and make payments from. And I think that a lot of us are generating and labeling a lot of our transaction data on those platforms. So I think it would be very helpful to have some sort of integration with this Web3 accounting tools where, you could actually just bring that data into these Web3 accounting tools without having to relabel the same transactions again. For us, again, we're not using any of those. So for us, it's basically Etherscan APIs, extracting Etherscan data, converting to CHF, and then it's a manual way or semi-annual way of labeling and attaching, supporting documentation to that for accounting purposes. But I think that would be, I think working with different payment providers that most of the protocols or Foundation are using would, I think, help with some of the labeling of transactions, in my opinion.
Maybe we can move on to the next slide, which is, I called it the team setup for crypto bookkeeping. And there's some specific questions I want to ask regarding, for example, first, the chart of accounts. So the chart of accounts in your traditional ERP, it's not going to fit the chart of accounts required for crypto bookkeeping, of course. So what are some of the best practices, again, on creating a chart of accounts for different blockchains, cryptocurrency? How do you guys go about when you're creating this chart of accounts?
So I have a good example. I do part-time accounting for a DAO called dOrg, and so I had to basically set up their entire chart of accounts, their crypto account, and then connect those two. And so I thought it was so funny when I opened up our QuickBooks account, all of these default chart or accounts were in the chart of accounts, and none of them applied to anything that we were doing. There's some things like depreciation in there, and like I think like share-based compensation expense, and like we had nothing like that. And so for me, I really sat down, and it kind of goes back to what Joe was saying, like what are the business processes that your company is engaging in? Like what are your revenue streams? And so really just kind of getting back to basics and thinking about like what is our business or what is our DAO actually doing? And so through that, I was able to set up a chart of accounts that actually reflected all of our activity. And so like I replaced depreciation, I took that out and replaced it with like a gas fee expense or things like that. And so that's how I sort of approached it. I analyzed each account that was just in the default list of accounts, and I asked myself, well, does this actually apply to anything that we're doing or no? Or you can just maybe slightly change things. Like if there was like a bonus, I would change that to a token bonus expense. And so really just making these small changes or big changes like deleting and adding accounts to reflect the reality of what's actually happening. And so that was sort of one piece on setting up the chart of accounts. But I think another thing to also consider is how do you want to display your crypto assets? Because under US GAAP, they're intangible assets. And so do you just want to have like one big account, like a catch-all that's your entire digital assets? Or do you want to split it out by maybe a separate account for each of your top holdings? And then there's stable coins. Do you want that to be a separate account? Because those could be financial assets, which are accounted for differently. And so it kind of gets back to like, what does management, what does executives, like, how do they want to see the data since they will be consuming it? And kind of combining that plus with the guidance, like what you're allowed to report under and things like that. So yeah, I think, again, it really just depends on the company. What does it look like? And how do you want to present your crypto activity? One thing that I also like to consider as well is impairment. I know we still have to do impairment. That's probably going to change in the coming months or next year. But just another thing to consider is when you book your impairment expense, do you want it to directly hit your, well, it's going to hit impairment expense, but do you want it to directly hit your intangible asset or digital asset account, or do you want to create like a separate account that's like digital assets impairment and have it booked there and then net those two together? And so that's a very specific example, but it's come up in my previous experience and definitely something to consider.
Yeah, what I find really interesting as well is that quite often, because I don't know about you, Mackenzie, but we also operate a traditional arm of the business in terms of we operate a business model, accounting for normal businesses that aren't crypto, right? And it amazes me that people don't update the chart of accounts by default, depending on the business model that's working anyway in the traditional world. And it's a really funny thing, because we've had this conversation a few times, not you and I, Umar, but myself and other people. And people always say, oh, how do you manage the chart of accounts? How do you change this? And I'm like, well, we kind of bespoke most chart of accounts to the business model that's operating. And I understand that there'll be some default ones, but so yeah, for me, it's about, again, doing, if you're going to do your job properly for the business that you're working for, and you're going to be really adding that value and adding that advice, you should always look at bespoking the chart of accounts anyway. So yeah, I totally agree with Mackenzie, looking through what you're doing and putting like you say, creating, I guess, a couple of things. One, a management report. What do the management want to see, as you said, Mackenzie? And then secondly, what do the authorities want to see? They're quite often different, in more ways than one. Yeah, so I think that's important as well, because management accounts and management information is really, really important, especially in this space. So I think that is just as important. It's not just creating something that the authorities want, but also creating something that would be really useful for the founders or for the the lead team or whatever to really look at that and make some decisions, etc. The second point is really interesting around reconciliation and kind of those completeness checks, because in the boring accounting world, at the end of the year we say, please can we have your bank statements, and can we have a look at your bank statement and see that there's 100 grand in there, and then we look at the accounts and we can see that there's 100 grand in the accounts, and it's wonderful and everyone's happy. In the crypto world, that doesn't as such happen, in that you can't just go, do you know what, Etherscan, can you tell me the balance of this wallet 6 weeks ago or 2 months ago or whatever? So yeah, so I think that is a challenge that we need to try and overcome as an industry. How do we do that completeness check fully? We have got some processes to minimize the risk of that being incorrect and to minimize issues with that. But I think it is something that as an industry, and I don't have the answer, but I think it's something as an industry that we should think about. How do we look at that? Making sure. One example actually I'll give you is we had a client that was operating on NIA, and the NIA Explorer showed the same transactions as the software we were using when pulling the data. So why would we think any different than it was correct? But when we presented it to the client said, well, I made this transaction over here and I made this transaction over here, and they showed us the hashes, and they just weren't in the Explorer, and we just couldn't understand why. And so it's things like that where we would never have found that without speaking to the client, because we would never have known that they'd done these transactions that weren't showing. And I can't remember what the exact solution was in the end, but it's those sort of things that if we had an element of that, like you say, completeness check, and it might sound a bit boring and a bit accounting-y and a bit mundane, but it's really important for everybody that we get that part right. So yeah, it is something that, and there's a challenge to the software providers out there to go and find out how we do that, because nobody in reality takes a snapshot on the day of the month end or the quarter end or the year end or what have you and sends it you in a nice pretty picture. So we've got to work out a way to do it.
Yeah, that's very interesting. I mean, just touching quickly on the chart of accounts for us, I mean, our accounting is outsourced, so we don't directly have control over designing our chart of accounts. Or preset by our accountants. And I think at least being based out of Switzerland gives us perhaps a little bit more flexibility in terms of presenting our financial statements and perhaps allocating some of the things across different categories. We also do, like I think we mentioned, there's like basically two sets of financial statements that we prepare. One is your local statutory accounting statements, and then we have a separate set of financial statements for management reporting that's a little bit different, that perhaps more informative for how our leadership and the board looks at our performance and financial position. But then in terms of like how we track our wallets, I think, like I mentioned before, we look at basically per wallet and per asset. So we're currently operating just on Ethereum mainnet. So maybe perhaps in the future that would be a world where you're actually looking at per blockchain, per wallet, per asset, which I don't know. I don't even want to think about that complexity, but yeah, that's how it currently looks from our side. In terms of like reconciliation, I agree with Joe. I think there's, I think you want to be able to trust that the single source of truth for you, at least for Ethereum transaction, is your Etherscan, right? And I think we're putting all of our faith into that. That is 100%. The balance that it is, but I think we're also like, checking against different sources, right? You have your internal records based on your starting balance, your transactions, your ending balance should be, matching. Comes to whatever balance it comes at the end of the month or whatever cutoff period you're looking at. Then you're comparing that to Etherscan, you're comparing that to your Coinbase statements or whatever centralized custodian you're using. So I think like checking against different sources also helps. But yeah, I think that's kind of like how reconciliation looks like in our case. Other controls, yeah, I don't know if I have any thoughts about the last one, but I'll keep it open.
And Mackenzie.
Yeah, I got some thoughts, especially on the reconciliation piece. So just want to share this link with everybody. So some block explorers like Etherscan and Polygon Scan, you can actually check historical balances. And so this has been such a lifesaver on both of these chains, because you can check the historical ETH balance, but you can also check historical ERC20 balances. And so for any network that like my clients have operated on that sit on top of Ethereum, like I definitely rely on these two tools. But also, I know it sounds like super mundane, but just taking snapshots of like a block explorer, maybe at month end or quarter end, especially at year end, is just super critical, because I've done reconciliations where it's, you're basically adding up all the inflows, outflows, seeing if it comes to an ending balance, and being able to do that throughout time is great. And it's definitely has helped. And so it takes a long time, and I know it can be a little bit messy, but especially for networks where they don't have a balance checker tool, like you have to kind of create your own balance checker tool. And yeah, I definitely recommend that. And then on the reconciliation piece, another thing I'd recommend is definitely a token roll forward schedule. And so you can get it both in, I'd recommend getting it both in tokens and also in the fiat version. So you can see like, what's my beginning balance in tokens, add any deposits for the period, subtract any cents, and then you get to your ending number of tokens. And then I've also seen roll forwards where you layer in like the cost basis, the gain and loss, any impairment expense to get to like the final carrying value, which is cost basis minus impairment. And so it's really tricky to put this together, or at least like to verify the data, but especially if you're getting audited, the auditors are going to ask for something like this. And it gives you peace of mind that like all the crypto revenue you booked or all the gains and losses you booked for the year are actually correct, or like in the ballpark range of being correct. So I definitely recommend that too.
Yeah, that's really interesting. Mackenzie, is that token checker new?
It's definitely been around the last 6 months. I think I found out about it because I was working with a sub ledger, and they showed me this tool because that's how they check their balances for Ethereum. And I think the balances are actually pretty correct, because sometimes the block explorer can be a little finicky. Based on Etherscan, I've never run into an issue where it's like, oh, this token check tool is incorrect. Like, it's always been correct. So fingers crossed that it stays that way.
I think as well, as long as you are doing as much you can to put those checks and balances in place, even if you do come unstuck slightly, the authorities, I don't know about the US, but in the UK, would be understanding to that and wouldn't, kind of throw the book at you, as it were, just because as long as you put in, you've got your own reconciliation tool, you've got, a few checkers online and things like that, then I think, most people will understand that you're doing your best to get that kind of reconciliation in place. But I think, like you say, the other key part is that audit piece. An auditor's not going to accept, I think this is right. They're going to want to see a detailed reconciliation as to why it's right. And that obviously is important. I think as well on the other controls piece, we do my background is a more kind of CFO, finance director type piece before I did this business. So for me, financial controls is quite important from an internal perspective, right? In terms of, making sure that you've got the right controls in place to ensure that the business can operate in the most efficient way. And that then does come back to, as Mackenzie mentioned earlier, having a wallet, for example, for particular transactions. Because if you have one wallet that does 55 different things, then you're going to have a really difficult time when your team tries to then reconcile it. So you should put controls in place to make sure that in the same way that you might use a bank account or another account for other things, you should do the same in crypto. And I think, like I say, for me, all of this comes back to communication. Talking to our clients and our clients talking to us, and really working together, communicating, collaborating, and really working together to get this in the most effective and clean and tidy way is the only way you're going to operate, I think, in the space now.
Yeah, and then on the other controls piece, just a couple that I'd recommend. So I think Joe mentioned this, but just make sure all the wallets in your subledger are actually yours. So it's always good to confirm with your CTO or whoever is creating the wallet addresses that these are actually your addresses. And so it's more of maybe like a security control, but having a process in place for the dev team or whoever's spinning up new wallets, it has to go through levels of approval. Maybe security team has to approve it. And then there, of course, has to be open communication between finance and accounting teams and the engineering teams. In crypto accounting, they really have to talk to each other. Also, if you're keeping assets in custodians versus self-custody, I think is generally a good control if you're able to, not only for the security reasons, but usually these custodians will give you a transaction log or some kind of statement that you can reconcile to, which is really great and of course good for audits. And also, I think it's important to just keep a tab on who actually has access to your main crypto subledger if you do have a software solution. Just because I've noticed that pulling activity logs is kind of tough. I think of QuickBooks or NetSuite, it's really easy to get an audit log of every single transaction and who's done something with whatever journal entry. It's kind of hard to get that in a subledger, I've noticed. And so again, just helps with security, data integrity audits. And this one's kind of an old school control, but just a separation of over who has custody over the tokens from who's actually recording the transactions. If you've got an accountant and they're sending out, I don't know, some payments, but they're also recording it in whatever system where they're doing the subledger accounting, that could lead to some not desirable activity. So just always good to separate those two functions.
The last slide I have for today is how to approach the different market solutions for crypto accounting. So like I said in the intro, Mackenzie and Joe, you've had your hands on a lot of the different crypto accounting solutions out there. And Greg, you've been exploring a lot of them. The other day I had Modesta from our club share a little bit about the different criterias to think about when it comes to choosing a crypto accounting solution. So what I want to ask you guys is, given that you've been exploring and testing a lot of the different market solutions out there, what in your experience should CFOs be thinking about when it comes to choosing one on the market today?
I've got a lot of opinions on this. I'll be quick. You've got most of them down, and there's people on this call that I talk to a lot from a software perspective, and most of them know my opinion on a lot of these things. Number 5 on this list for me right now is one of the biggest problems that we've got in this space, and I'm not blaming anyone. It is what it is. But the biggest problem we find when closing deals with clients, or when getting them onto a tool, that we try and deliberately not to specifically name names, but that is the biggest challenge. And we have had clients that have not signed up to us because of the tool, or have asked us if we'll just do it all manually because they don't want to pay the price of the tool. And if we in the UK, we do use QuickBooks a bit, but we're quite heavy in the Xero ecosystem. So we use Xero, for example, and the top price in the UK for Xero is £30. So what's that, $40 or $45 or something like that, right? So to then look at charging $500 a month, for example, or $300 a month, something like that, for a software tool is challenging. And like I say, I'm not blaming the providers themselves, but it is something that needs to be looked at as we scale as an industry, because it isn't sustainable for businesses to be able to pay that on software, and they're not willing to. So yeah, that is one of the biggest frustrations, and I'd be interested in this, Mackenzie, if you have the same kind of problem. But I think the other ones on the list are pretty good. They've got to be ready to react. Things change in the crypto world. Even something like Ethereum will have a change to its system, i.e. proof of work, proof of stake. You've got to be able to move. So even these more kind of larger projects will still have big changes, and they've got to be able to react. Support is key. I liken it to something like Zero, where we act as a frontline support for that software. So we have X amount of clients on that software, and they don't need to go to Zero, they come straight to us. So that support that the business needs to give to the end user is scaled up into the hundreds rather than one-to-one, if that makes sense. So I think, as an accountant in the middle, supporting us so that we can support the clients is really important. And yeah, being willing to, as they say there in point 2, being willing to change or to mold. I had one this morning. I messaged a guy I know, it was on the personal tax side rather than the business tax side, and I said, look, I've got this really big client and he's on this network, and I know you don't support it, but I need you to help me with this somehow, some way. And his reply was, yeah, let's jump on a call, we'll get a solution for you, like let's work on it together. Like that's how it needs to be. So yeah, they're my kind of takeaways, I guess. But Mackenzie, I would be really interested from your side, like what you see and whether I'm wrong in the price thing.
No, I actually couldn't agree more with you. I think you covered pretty much everything there, and especially agree on the price. I don't think the subledger market has really found the sweet spot for its pricing model yet, or its pricing strategy. So I'm excited to see the industry, like this particular industry, evolve and get more to like maybe a SaaS model that is more cost effective, especially if you're like a smaller crypto startup, or even if you're just a traditional company and you just have a few crypto addresses, if you're not going to pay maybe like $5,000 a month or something for a crypto subledger. So yeah, definitely agree on that piece. And then you pretty much mentioned it all, but I would just say, like, when you're thinking about like what solution should I really get on, I would really look at network coverage, like looking at what blockchains are you on versus like what networks do these other subledgers support. Just because if they automatically sync in the data, then that's going to make the accountant's life like 10 times easier, and it just avoids a lot of manual error or potential for manual errors. So really just want to emphasize that as well. But yeah, no, Joe, I think you covered it all. I cannot agree more.
Yeah, if I may add, I think the one thing for me would also be just the ease of, switching or onboarding to the tool. I think that, having some sort of like automated way to, like we don't, like even us, we have quite a bit of wallets, a lot of which maybe, dormant or infrequently used, but you still want to, like cover everything. So having something where you're not, manually adding each Etherscan wallet address and like extracting and waiting for all transactions to sync, having something where, you can do that in a more like bulk upload or some more scalable way. I think that makes, me switch to a tool as opposed to something that I'm using now a lot easier. I think like, yeah, I think a lot of like what both Joe and Mackenzie have said, like, making sure that you're 100% covered, you have all of the integrations and connections that you need. I think that makes sense. But then also at the end of the day, I think especially for smaller foundations and protocols, I think at the end, the price still has to make sense, So I think there's maybe some thinking to be done around like what is a appropriate business model, how, for a different size of foundations and protocols, or how they're using a different tool, or what features they use. I think that all makes total sense to me. But yeah, I agree with the list that you guys have put out here.
And if I can, just really quickly, I think what's really, really important that I mentioned the price thing, and I mentioned that the providers have got an element of responsibility on that piece, but I also think the client has and the business has, because clients and businesses use like 55 different exchanges and wallets and blocks when they don't need to use all of those different ones. They could consolidate all of their, for example, all of their kind of off-ramping onto Kraken, for example, or any trading they do, they could do on Binance, or whatever it may be. But they try KuCoin and Binance and et cetera, and then in the end they go, oh well, this software provider A is really expensive and B doesn't support all the exchanges I use, and it's kind of like, well, do you really need to use all of those weird and wonderful exchanges? So I think there's an element of responsibility on the business and whatnot to streamline what they do, and be a bit more sensible and maybe a bit less degen-y in their kind of way they're operating as a business. I think that's important as well.
We have a few minutes left, so maybe we'll take a few questions from the audience. I see there's 2 questions right now in the audience, from the audience. There's a question from Eric from Flowdesk. Did you mention which fixing you would apply for the closing counter value in your books? I don't know what fixing would mean here, but which external or internal source to be used to be acceptable as an authority point of view. So maybe Eric, if you could tell us what fixing would mean. Okay. So when it comes to using a pricing source, I believe, to value your crypto assets and at month close or at year end, yeah. So what pricing source are you guys using, or how do you go about when it comes to pricing source?
That's interesting as well, because a lot of the time the software provider themselves is using a pricing source. And another I say interesting point, it's not interesting, but unless you're sad like me, is that they use different ones. So like, you'll have one software provider using, I'm making up CoinMarketCap, for example, and then you'll have another one that uses maybe DEX Screener to pull some more exotic tokens that are maybe just on DEXs and things like that. But yeah, there doesn't seem to be a consensus from what I've seen across the industry that everybody goes, do you know what, this is the one where we should use. And I think a lot of the time, especially with some of the more, like say, exotic tokens that we don't use as much, we have to kind of go to the best available source. But one thing I will do, if somebody's holding a significant amount of a particular token, whether that might be their own token or if they're a project that's launched a token, but a significant percentage of a supply of a token, is I'll always look at what price impact it would have if I was to sell all of them, for example. So if you were, the Myna token, for example, and I held 90%, if I sell that 90%, and let's say on the balance sheet it's worth 5 million quid, or dollars, that if I sell that at 90% holding, I'm not going to realize 5 million from that. So that's another really interesting point, and sometimes you can do that quite quickly. So I think that's interesting as well, is to make sure that you value a token at a particular price, but also then look at the real value you're going to pull from that if you were to sell that in a bulk.
Yeah, 100%. And then in the US, we have to do principal market pricing under US GAAP. And so that's definitely one of the considerations. Like for each individual asset, you have to look at like what exchanges do I have access to and which ones have the most volume for the particular asset that I'm trying to sell. But then you also definitely have to consider, if I were to sell my entire holdings, would that completely crash the market? So I definitely look at liquidity as well. Because like on osmosis, for example, like some pools have liquidity of like 20K or something. It's like, well, I can't really use that or like depend on that price that's there. So yeah, at least for us, we have to do an analysis, a token by token analysis, and then use that pricing maybe like for Atom, like I had to use Binance, or maybe for like Flare, it's on Kraken or something, like, and you have to basically use that pricing source and plug that into your subledger. And so you have to find a subledger that's willing to support different pricing sources per token, at least in the US.
Yeah, I mean, for us, we don't have any like very exotic tokens, or native token is valued at a cost. So we're not applying any sort of like market valuation on our native token. But for others, I think like Joe said, I also agreed that there hasn't been, or that I know of anyway, a consensus of whether you should be looking at a specific spot value or like an index. So I think for what you're using now, at least for the most widely traded assets is actually pricing aggregators. So using weighted volume pricing across most liquid exchanges. So I think a good example of that was I think the collapse of FTX, and like if you were taking a pricing of FTX spot markets, because I mean some of the tokens are the liquidity could not have been, or spot liquidity could not have been available on other venues. Then I mean you're out of pricing index. So what I think you don't want to I think at least for me, my logic was I don't want to be exposed to a single venue. So hence we're opting for indexes as a response yet.
And sorry, one last quick note on this, Umar. So I do think about pricing in terms of different tiers. So at least for me, like in the US, principal market would definitely be like tier 1 if I can pull that. But if there's no principal market, let's say, or maybe it's for an exchange that I don't have access to, then I would default to a price aggregator like a CoinGecko or CoinMarketCap. If there's no pricing there, then I would look at, well, is it like a private valuation price? No price there, then look at, okay, what's the labor cost estimate if I provided a service? How can I price that? And then if anything else, then it would just be zero cost basis. So I definitely go through those different levels.
There are some as well. Sorry, I know we're answering one question in quite a long-winded way, but there are some tools, and Luca is one of them, which will kind of offer a kind of aggregated price mechanism where it will kind of look at the consensus of what a price should be based on liquidity and trading volume and things like that. So yeah, I don't know, Mackenzie, if you've used Luca in the US, but it has done some pretty good stuff for us in the UK.
Yeah, we got Luca. We've also used DAR before, Digital Asset Research. They do pricing by principal market, and we'll just do that analysis for you. So there's definitely providers out there. You just got to find them and see if the cost is worth it.
All right, so we've reached our 1 hour time limit. So there was a last question from Arya, but we're out of time, and I see he's not in the audience anymore. Yeah, so thanks a lot, guys, for coming today. Thanks a lot, Mackenzie. Thanks a lot, Joe and Greg. Thanks to the audience. I want to ask you to please let us know about which next topic we should cover in this webinar. The webinar today was really, really insightful. You guys have shared a lot today. There's a lot to process, and please just let us know what next topic we should be covering on Slack.
Thanks for having me on. This has been super fun.
Thanks, Umar. Thanks for having me.
Thanks, guys.
Yeah, thanks, guys.
Have a good one.
Thanks, you too. Bye.
Bye.